Wall Street analysts have it completely wrong on Intel. The data buried in their latest filing reveals something they hope you never calculate yourself. In the next 15 minutes, you will see exactly why the smart money is quietly repositioning while everyone else panics. Here is what the financial media will not tell you. Intel just recorded something in their filings that contradicts every bearish narrative you have heard. But to understand why this matters, you need to see the full picture first. Back in 2018, Intel was untouchable. They controlled over 90% of the data center market and printed money quarter after quarter. Then something shifted. AMD started eating their lunch. Nvidia captured the AI narrative. And suddenly, the semiconductor giant looked like a dinosaur waiting for extinction. The stock cratered. Analysts fled. Retail investors panic sold at the worst possible moment. But here is where it gets strange. While everyone focused on the obvious decline, institutional investors started doing something unexpected. The question is why? And what do they know that you do not? By the end of this breakdown, you will understand exactly what is happening. Let me show you the number that changes everything. Intel's research and development spending hit $20 billion last year. That is more than AMD and Nvidia combined. Now, most analysts look at this and see a company desperately trying to stay relevant. But here is what they miss. If this is already challenging what you thought, drop a like so I know to keep going. That R&D spend is not random. It is strategically allocated across 3 specific areas that could reshape the entire semiconductor landscape. First, their 18A process node. This is Intel's moonshot. If it works, they leapfrog TSMC in manufacturing capability. Second, their foundry services division. Intel wants to manufacture chips for other companies, including their competitors. Third, AI accelerators. Everyone thinks Nvidia won the AI war, but the battle has barely started. The mainstream narrative ignores all 3 of these bets. But the numbers tell a different story entirely. But here is where I need you to pay attention. The bears have a point too. Intel has missed execution deadlines before. Their 10-nanometer disaster cost them years of progress and billions in market cap. Investors got burned. Trust evaporated. So why would this time be different? Here is the pattern interrupt you need. Intel's new manufacturing strategy is fundamentally different from anything they have tried before. They are not just building better chips. They are building an entirely new business model. Think about it. Every major tech company needs chips. Apple, Amazon, Google, Microsoft. They all rely on TSMC right now. That is a massive geopolitical risk. One company in Taiwan manufacturing the world's most critical technology. Intel is betting that American companies will pay a premium for domestic production. And recent legislation just handed them billions to make it happen. The CHIPS Act changed the game entirely. Now let us talk about the money. And this is where Wall Street gets sloppy. Most analysts focus on Intel's shrinking margins and declare the company dead. But they are using the wrong framework entirely. Intel is in investment mode. They are spending massively today to capture tomorrow's market. When Amazon built their fulfillment network, they operated at losses for years. Wall Street hated it. Investors who understood the strategy got rich. Intel's free cash flow looks terrible right now because they are building fabs that cost $20 billion each. But here is the math nobody does. Once those fabs come online, the operating leverage is insane. Each additional customer adds nearly pure profit. The fixed costs are already paid. The bear case assumes Intel stays in decline forever. The bull case sees them emerging as America's semiconductor backbone. One of these scenarios will make investors very wealthy. The other will not. But that is not even enough. Real story. What I am about to show you is the part that made me completely rethink this company. Intel's 18A process node just passed a critical milestone. If you want to see how this plays out, make sure you are subscribed. Early test results suggest they might actually leapfrog TSMC. Let me put this in perspective. For the past decade, TSMC has dominated advanced chip manufacturing. They make chips for Apple, Nvidia, AMD. Everyone. Intel fell behind and became a laughingstock in the industry. But their 18A node could change everything. Independent analysts who have seen the early data are quietly revising their models. The yield rates are better than expected. The power efficiency metrics are competitive. And here is the kicker. Intel owns their own fabs. They do not have to wait in line like everyone else. If 18A delivers, Intel becomes both a chip designer and the world's second most advanced manufacturer. That is a moat nobody else can replicate quickly. Now here is the part that keeps the bears awake at night. Intel's foundry customer list. They announced major wins with companies like Microsoft and Amazon Web Services. These are not small test contracts. These are strategic partnerships worth billions. Think about what this means. Microsoft and Amazon are essentially betting that Intel can manufacture chips competitively. These companies have armies of engineers evaluating every option. They chose Intel. The skeptics say Intel will never attract enough customers to make the foundry math work. But they already have two of the biggest technology companies on the planet sign up. And here is the pattern nobody is discussing. Every new customer de-risks the investment. Every successful chip run builds credibility. Every partnership validates the strategy. Intel is not asking you to trust their promises. They are showing you contracts signed by sophisticated buyers. Drop your prediction in the comments. Did you see this coming? Let us address the AI elephant in the room. Everyone says Nvidia won and Intel lost. But the data tells a more nuanced story. Nvidia dominates AI training workloads today. That is undeniable. But training is only half the market. The other half is inference. Running AI models after they are trained. And inference is a completely different game. It requires different chip architectures optimized for efficiency rather than raw power. Intel's Gaudi accelerators are specifically designed for inference workloads. Early benchmarks show competitive performance at significantly lower price points. Here is why this matters. As AI goes mainstream, inference demand will dwarf training demand. Every AI assistant, every recommendation engine, every automated system runs inference. Intel is positioning for the bigger market that most investors are ignoring. The AI story is not over. It is just beginning. So what is the actual valuation case?